Look at this chart. Equal highs up here, equal lows down there. Price just sitting in the middle. Which way does it go? Most traders guess. They've got a reason to go long, a reason to go short, and honestly, no real way to know which one wins. So they enter on a feeling and exit on a feeling too. Cut early because they get nervous. Held too long because they got greedy. This video is the fix for that. By the end of it, you're gonna look at charts and know exactly where price is being pulled towards before you ever place the trade. Here's the whole idea in one sentence. Everything else today is just explaining it properly. You enter from the middle of a range and you target the edges. That's it. The middle of any range is where price tends to leave behind little pockets of unfinished business. Gaps it moved through too fast to fill properly. The edges where the real liquidity sits, where the stops are, where the big pools of resting orders are waiting. Price tends to get pulled towards those edges and it often stops to fill the leftover business in the middle on the way there. Learn to see both and a chart stops looking like noise. It starts looking like a map with a destination already marked on it. Any move on a chart, any time frame can be looked at as what's called a dealing range. It's got an edge on top, an edge on the bottom, and everything in between. The top edge, the swing high, the session high, whatever the recent swing high is, usually has a pool of orders resting just above. The bottom edge has the mirror image, a pool of sell orders resting just below it. Everything inside those two edges is where price left behind a little inefficiency as it moved. Gaps, imbalances, spots it blew through without really trading properly. So at any moment, price is basically doing one of two things: getting pulled towards one of those outer pools or pausing in the middle to fill in something it left behind on the way there. Let's talk about these edges because it's where the big pools actually are. Above a high, you'll usually find a cluster of buy orders resting, stop losses from people who shorted near there, plus breakout traders waiting to jump in if price pushes through. The more obvious that high is, equal highs especially, is where a bunch of retail traders all see the same resistance and stack shorts in the same spot. The more loaded, the more obvious that high is, equal highs especially, where a bunch of retail traders all see the same resistance and stack shorts in the same spot, the more loaded that pool tends to be. Below a low, it's the same story in reverse. Stop losses from longs, breakout sellers waiting for a trigger, all resting roughly in the same area. These pools aren't really support and resistance the way people usually think about it. They're targets. Price tends to get drawn towards them because that's where the orders are that makes the next big move possible. And when price actually gets there, you'll see one of two things. Same pattern we've covered before. It sweeps through and reverses, or it pushes through and just keep going. The reaction tells you which one you're looking for. Now, the middle of the range. This is where the entries actually tend to happen, and there's two main things to look for. First, fair value gaps. When price moves fast, it doesn't trade through every price evenly. It jumps. Look at 3 candles in a row. If the high of the first candle doesn't overlap with the low of the third, there's a gap in between where price actually never traded. That's an imbalance. The market tends to treat the untraded space as unfinished. It often comes back to trade through it, not necessarily the whole thing. Usually just the midpoint of the gap tends to be enough to trigger a reaction before continuing in the direction it was already going. Second, order blocks. This is just the last candle moving the wrong direction right before a big move happens. Say price is about to rip higher. The last red candle right before that happens is often where the real buying power was actually stacked up. Price tends to come back and revisit that zone before continuing higher because whoever was buying there usually didn't get their whole position filled in one shot. Both of these work for a similar reason. Price left something unfinished and it has a habit of circling back to finish before moving on. Here's the piece that separates a sloppy entry from a more disciplined one. Take that same range and split it in half. The bottom half is usually called discount. The top half is premium. Simple idea. If you're bullish, you generally want to be buying from the cheaper half of the range, not the expensive half. If you're bearish, same thing in reverse. You want to be selling from the expensive half. So when you find one of those gaps or order blocks, the next question is, where does it actually sit in the range? A gap sitting in discount in a bullish setup tends to be much stronger entry than one sitting in a premium. Same gap, same shape, completely different quality, just based on where it happens to be. If you're trying to buy from up in premium or sell from down in discount, you're basically fighting the structure of the range itself. how this actually plays out. This is the pattern that repeats over and over on basically every time frame, every session. Once you see it, you start seeing it everywhere. Price is sitting in a range, pools above and below. At some point, price gets pulled towards one of them. Say it dips down and sweeps the low, grabbing the resting sell orders there. That's usually the move that shakes people out. From there, price often moves fast in the other direction. A real push, leaving behind those gaps we just talked about. Then it tends to pull back into one of those gaps or order blocks before continuing. That pullback is what usually looks like a reversal to everyone watching, but it's often just the pause before the real move continues. If that entry holds, price then tends to head over to the opposite pool, the highs in this example, and eventually reaches it, sweeps it, and the whole thing can start over and over again in the other direction. Sweep, push, pull back, deliver. That's the loop. Mark the pools, watch for the sweep, wait for the pullback, and you've got your entry, with the far pool already being marked as your target before you even got in. Before taking a trade with any of this, there's really just 3 questions worth asking. Where's the pool? What is the nearest pool of resting liquidity in the direction you're leaning? Not a random risk to reward number you picked because it felt good. What is the actual nearest pool the chart is showing you? Where's the entry inside of that? Between where price is now and that pool, is there a gap or order block sitting on the right half of the range? That's where you're watching for the pullback, not at the pool itself. Lastly, does the bigger picture agree? A larger structure, daily for example, might have its own pool further out that matters more than the smaller one you're looking at. The smaller time frame gives you an entry. The bigger one tells you the real destination. Both need to point the same way. Quick tie together, because this whole series really does connect. Those 3 lines or levels from the last video, the daily open, the weekly open, and the new week opening gap midpoint, those can sit inside a bigger range and help tell you where the price is currently on the cheap half or the expensive half. When one of those lines happens to line up near a gap, that's usually a stronger entry than either one on its own. And the sessions from the video before that, the highs and lows Asia or London leave behind, those actually are the pools that we've been talking about today. That's the external liquidity. The kill zone is just the window where price tends to actually make that move from the middle out towards one of those pools. So really, sessions tell you roughly when. The 3 lines give you a reference price, and everything in today's video tells you where you're actually getting in and where you're actually getting out. A few patterns worth watching for in your own trading, since these tend to show up a lot. Entering right at the pool itself, expecting an instant reversal with no confirmation. Wait for the sweep to actually finish and for the pullback to actually form first. Picking a random reward target instead of marking the real pool. If the actual liquidity sits closer than your ideal ratio, that's what the market's offering, not the number you had in your head. Treating every gap the same. One sitting on the wrong half of the range or one that's already been revisited a few times tend to carry a lot less weight than a clean, fresh one in the right spot. Ignoring the bigger picture. A great small entry means very little if a bigger pool is sitting right in the path of the trade. And probably the most common one, taking profit too early because of a small pullback, even when the original idea is still completely intact. If the reasoning was sound, it's usually worth letting the trade actually reach where it was heading. So next time you're looking at a chart wondering which way it's going, stop guessing. Find the nearest pool of liquidity in the direction you're leaning. That's your target. Then find where price would need to pull back on the way there. That's your entry. Enter from the middle, target the edges. That's really the whole idea. And if you've been following the series so far and you're ready to actually put this into live action on a chart, Gates FX is the platform I trade all of this on. Links in description if you want to take a look. This wraps up this video. I hope you were able to learn something and you're able to tie it all together. Now go mark it up on your own chart before your next session. See you on the next video.